Well, hello. I'm coming to you live from my apartmento. Hello. Okay, before I begin, let me introduce you to a few of my folks. Ready? All right, here we go. Okay. Right in front of you here is our lovely, pretty. Say hi. That was pretty. Wait. There's more. There's more folks. Come on now. It's a full house. We're packed. We're packed. Here we go. Handsome Maxwell. Oh, Cookie. Cookie, say hello. Hello. That's Cookie. He barks. And of course, you guys know. Well, if you don't know, you're gonna know. And here she is. Here she is. Luna. Hello. Girl got lucky. We were walking in the neighborhood, and we found some ginormous cow husks and cow shanks. Yes, brought it home, washed it, and day 2 that she's working on it. Okay, now for this special segment, it's very brief, but it's still special nonetheless. I want to make a discussion with you. I want to talk to you about, still on the topic of life insurance. In my last video, I mentioned the permanent life insurance. Now, I also gave a number, the face value of the life insurance, $250,000. That's not the typical life insurance if you're talking about protection, especially when it has to do with for the rest of your life. However, most people, as a dry run to just initiate the process, do start out at a low amount, and that helps with that possibility and the ability to actually kind of bump up, so to speak, or just to have the potential of earning, like say money in your life insurance, what we call the infinite banking, which is a savings component or a savings feature that's implemented in the life insurance policy, but that's only for certain policies, and those are typically whole life policies that go until age 100, or permanent policies that go until 120 years old. However, there are a certain amount that you have to keep in order to, maintain the policy. Okay, but enough of that for right now. What I want to pay close attention to, or be in terms of specificity, is how we come up with the face value. All right. Now, this process is quite simple. We do what we call a financial analysis or budget analysis, and it's based off of 5 components, right? All right, so I'm going to give you a brief looking of it, and it's called DIMER. Okay, what is the DIMER? It's debt, income, mortgage, education. We throw in the funeral expenses, and of course, retirement. Why are these features important? Glad you asked. Now, as far as the debt is concerned, how do we calculate debt? Is basically the total amount that a person owes. So if you have credit cards, car loans, any type of specific debts that you might have, we put that in the section of D for debt. Now we put the total amount. So if let's say you're making monthly payments of $100 a month on your credit card, and you're making $300 payments on your car note, and you have other types of unsecured debts or other types of debts out there, what we calculate is not your monthly payments, rather we calculate the total debt. So let's say, for example, on your credit card, your total debt is $10,000. We'll put that as your debt. Let's say your car note is $20,000 remaining on there. we put 20,000. So that's how much? 30,000 plus extra 5,000, another 5,000 there. So we're looking at a total of maybe 40,000. So for debt, that individual would be 40,000. So let's go ahead and just write that there. 40,000. All right, now next what we do is calculate somebody's income or the individual's income. So let's say, for example, you are earning, let's say roughly $50,000 a year. Now, that is not a total income. It's just you, the insured, or the person that wants to be considered for life insurance. That is what we would look at. Not your spouses, not your significant others, but yours. So let's say that income is 50,000. What we do at that point is we calculate $50,000 multiplied by 10, because that's 10 years. Because again, we want this to be a permanent policy, or we want it to satisfy as much of your needs when it comes to determining what your insurability needs are. And this is the reason why we use the dimer, by the way. Apologize if I didn't explain that earlier. So 50 times 10 is 500,000, right? Let me double check that. So 50 times 10 is indeed $500,000. Now let's say you're renting. You're an individual. You don't have a mortgage. You are renting. So if you are renting, then what we will do is calculate what your monthly rent is in 1 year, and we multiply that by 10. If you had a mortgage, and let's say your balance is, you've been paying on the mortgage faithfully, and originally when you purchased your home was 500,000, but over the course of the last 15, 20 years, you've been making good on your payment. God bless you for that. Maintaining the economy, you being fiscally responsible, kudos. So then now all you owe is $200,000. So what we would do is we'll put the $200,000 because of the total amount, because we want to say, God forbid, something happens to you. Because remember in the last presentation, I mentioned living benefits, and you get up to 80% of the value of the face value of your policy. So if you're getting something that's, where you will be able to receive payout on, and you're no longer able to perform your work as you did previously, you want to make sure you have enough income to satisfy your basic needs, such as paying off your debts, such as paying off on your mortgage, so that way you can still have a roof over your head, and so that way you can still manage and function in other areas of your life. Is that fair to say? Excellent. All right, so I'm going to put down with the assumption that the person has a total mortgage balance of $200,000 remaining. So then I'll just put $200,000 for mortgage. Now, education, I'm going to hypothetically say this person has 2 children that are under the age of 21. And, the education has to do for children that are minor, that you are going to fund in the near future for their education. So each child, the average cost of a private education currently is roughly about $150,000. So for 2 children, that's $300,000. So you see how this number is quickly increasing, right? I mean, just alone for your income replacement, it's $500,000. And then, of course, we're going to include your funeral expense in the event of that needing to be covered. It'll already be included, and it will not tap into your debt, your income, mortgage, or your children's education. So we have $20,000 coming up. All right. Now, as far as retirement, unfortunately, in that segment, in that area, life was not that great. So you don't have anything for retirement, and you're just finding out about life insurance. So you don't have life insurance. So as far as retirement is concerned, you don't have anything to reduce your insurable needs currently. Now, I'm going to add up 40,000 plus 500,000. 40,000 is the debt. Just recapping right quick. And then 500,000 is your income in 10 years. And then mortgage is the total amount that you owe on your property. Now, if you're renting, we will multiply how much you pay every month by a year, multiply that by 10. So if you're, say, renting $2,000 a month, we multiply 2,000 times 12 is 24,000 times 10 is 240,000. So it comes out about the same. In fact, it's cheaper with a mortgage in this scenario. Touche. Okay, so that's 200,000 for your mortgage. Education, because you want your children to go to school, even if you become disabled, and even if life happens, or under unfortunate early passing of death. Okay, so that's 300,000, and then we want to include funeral expense, which is roughly 20,000, give or take. But it's better to have a number there than no number. Okay, so here we go. Give me a brief moment. Let me get this done. Okay, so my calculation, based on all of your needs and based on all of the information, this is how much you need for insurance. For insurance, you need $1,060,000. Oh, what? Yes. Most people don't realize that they need more insurance than they actually think that they could afford. Now, mind you, my name is Norma Reeves. I am a licensed life insurance agent. I have different components. I've been given the privilege of seeing the other side of the what if. So in this scenario, what if, God forbid, you were to pass away before you got to check everything? You have your spouse, or maybe you don't. Maybe you're a single parent, but you're handling things. You have a 12-year-old and a 15-year-old. They're still underage, mind you. Now, God forbid something happens tomorrow. God forbid something happens down the line. Wouldn't it be good and wouldn't it be comforting to know that if in 1 year, 2 years, 3 years, 4 years, however long it is, if you were to pass on, if given a reasonable price, wouldn't it be good to know that you were responsible in protecting what's most valuable to you? And a lot of people think, oh, I don't want to put a price on me, but yes, we all have a price. We all have a number. It's called insurable needs, because if you are breathing, if you are living, and you are above the age of 18, you have certain financial responsibilities. Am I right in saying that? Is that fair to say? So if you have those financial responsibilities and they add up, wouldn't it be more fair for you to protect yourself in the proper way and in the proper mannerism? That is what life insurance does for you. Okay, so there's no need to worry. There's no need to fret. There's no need to think that, oh, this is what life is about and this is all I got to worry about. And then you have not only the stress of working now, but you have the stress of, if I die or if something happens, I become disabled, what is going to become of my family? You no longer have to carry that load on your own. Why? Because life insurance is doing that with you. Okay. Not necessarily for you, because there is still a binding that you need to do. There still is a binding contract and a binding agreement that this has to take place in order for it to be in place. Okay, so now with a typical person, $1,060,000, a life insurance retirement plan would be too much. Now, let me tell you though, just because you don't have the permanent policy or the permanent life insurance, it does not mean that your insurable needs cannot be met. I want to be clear on that. Okay? We do not only have the permanent policy, I also touch bases on a whole life, which is also called a return of premium, where you could have insurance, that type of insurance, up until 100 years. And what will happen is when you reach that 100 years or before, that money that you put into your life insurance will total up to the amount of the face value, and then it'll be returned to you. But that is something that, again, is on an individual basis and is based on each individual's needs. However, now the one that's most cost effective is called the term policy. But what is good is that Our faithful life insurance companies are becoming very, 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 what do you call it, efficient in knowing what our needs are and making sure that our needs are met. So let's say, for example, you have a child that's 15 and 13 years old. We want to make sure that they have protection and that you are protecting your family, at least for the $300,000. You want to make sure that that's going to be good at least until they reach the age of maturity, which is 21. So if you calculate 15, fast forward 21, that's 6 years. No problem. Okay. And then for your 13-year-old, fast forward an additional 2 years. So that's 8 years. So what I would recommend as a life insurance agent is for you to break down your insurable needs. So if you're able to get a term policy for the next 10 years, 15 years, that you can convert, by the way, that you'll have your living benefits intact and you'll have the face value intact, then I would strongly recommend that. Why? Because it'll cut the cost of a $1,060,000 policy into a third of what you normally would pay. So let's say, for example, for this type of policy, you're 45, let's say you're 50 years old, roughly around my age. Yes, black don't crack. I'm 49. But let's say you're 44, 45 or younger. $1 million policy for a permanent life insurance policy is about, of course, it depends on certain habits, but I'm going to give you a standard scenario. It's roughly anywhere between $500 a month, $300 a month. Now, mind you, this is on a permanent policy. But if we're looking at a term policy, I remember I said a third, right? So, excuse me, if you calculate a third, you'll be paying for $1 million and something dollars, $1,060,000. You'll probably pay less than $180 a month. I've actually seen policies that are less than $180. So yes, it is possible that we could still protect you even though you're so expensive. You know? So now the question is, what is next? Let's say I calculate all of this information to you. The only next thing for you to do is say, hey, get me some more information. How do I actually see which one is working for me? And how do I get the actual premium? What we will do is called an illustration. And this is something I will show to you in the upcoming video. All right. For now, thank you. That is all. Talk to you soon.